morning, everyone. Today, I'd like to talk about a significant event in the financial world, particularly for Japan. The Bank of Japan's decision to end negative interest rates. This marks a new chapter for the country's economy, and I'll walk you through the key points of the event. Let's dive in. After over a decade of what is known as ultra-loose monetary policy, the Bank of Japan, under Governor Kazuo Ueda, has raised borrowing costs for the first time since 2007. This move is seen as a historic shift as Japan moves past its long battle with deflation. Governor Ueda and the Bank of Japan have witnessed significant wage increases across the Japanese economy, providing the confidence needed to ensure that mild inflation will persist. This is a hopeful sign, as inflation has been a key target for the bank's policy for years. As a result, the Bank of Japan has adjusted the overnight interest rate to a range of about 0 to 0.1%, moving away from the previous benchmark rate of minus 0.1%. The negative interest rate policy was originally adopted in 2016 as a strategy to push banks to lend more, with the aim of boosting spending and guarding against the risks of a global economic slowdown. However, this policy was not without its drawbacks, as it placed increased financial strain on the banking system and allowed zombie companies to continue operating without truly thriving. The article notes that this policy shift by the Bank of Japan could potentially lead to changes in global investment flows, as well as indicate broader changes within the Japanese economy itself. For instance, workers at some of Japan's largest companies have secured their biggest pay raises since 1991, a sign of economic confidence. Interestingly, investor confidence seems to be on the rise as well, with the Nikkei 2025 stock index surpassing levels not seen in 34 years. However, despite these positive shifts, Governor Ueda has indicated that borrowing costs are not expected to rise sharply in the immediate future, as inflation expectations have not yet been securely anchored at the bank's 2% target. In response to the Bank of Japan's action, the yen weakened against the US dollar, and the Nikkei 2025 closed higher, as did the broader Topix index. Meanwhile, yields on 10-year Japanese government bonds fell. This nuanced reaction from the markets reflects a cautious optimism about Japan's economic trajectory. Inflation in Japan, mainly driven by the cost of imported energy and food, appears to be past its peak, with core inflation slowing down. Governor Ueda emphasized the importance of maintaining accommodative financial conditions while transitioning to a more normal monetary policy. In further move, the Bank of Japan has decided to remove its yield curve controls and discontinue the purchase of exchange-traded funds and real estate investment trusts, indicating a step back from aggressive monetary easing. The central bank will continue to buy Japanese government bonds at the rate of about 6 trillion yen a month, which underscores the ongoing challenges in the economy, such as sluggish household consumption. Governor Ueda has also hinted at the future reduction of the Bank of Japan's balance sheet, which signals a cautious approach to unwinding the bank's extensive monetary easing measures. In conclusion, the Bank of Japan's decision marks a bold and decisive step towards normalizing its monetary policy after years of aggressive easing. It reflects both a response to current economic conditions and the strategic positioning for the future. Thank you for your attention.